Most people believe successful investing is about choosing the perfect stock, but the truth is, the biggest investing mistake has nothing to do with stocks at all. It's using the wrong investment strategy for your age. A person in their 20s investing too safely can lose decades of growth, and someone in their 50s taking huge risks can lose years of hard-earned savings. Investing is not one size fits all. Your portfolio should change as your life changes. Because investing isn't just about money, it's about time. The amount of time you have before you need your money completely changes how you should invest. And today, you'll learn exactly how to build an investment portfolio based on your age. We'll cover how to invest in your 20s, how your strategy should change in your 30s, what to adjust in your 40s, and how investors in their 50s focus on protecting wealth while still growing it. By the end of this video, you'll have a simple framework you can follow no matter where you are in life. Let's start with the most important rule that guides every smart investor: the relationship between time and risk. Before deciding what to invest in, you need to understand one simple principle. Every investment decision comes down to two things: risk and time horizon. Risk is how much your investments can rise and fall in value. Time horizon is how long your money stays invested before you need to use it. And these two are directly connected. The longer your time horizon, the more risk you can afford to take. Why? Because markets move in cycles. Sometimes prices go up quickly. Sometimes markets crash. But historically, over long periods of time, markets have recovered and continued growing. If you're young, a market crash is usually temporary. You still have years or even decades for your investments to recover. In fact, downturns can become opportunities to buy investments at lower prices. But if you're close to retirement, time becomes limited. A large market drop right before you need your money can be very difficult to recover from. This is why smart investors don't use the same portfolio forever. They gradually adjust their investments as they age. Not because risk is bad, but because the role of money changes throughout life. Early on, your goal is growth. Later, your goal becomes stability and protection. With that foundation in mind, let's start with investors who have the greatest advantage of all: people in their 20s. If you're in your 20s, you have something more powerful than money: time. And time is the greatest asset an investor can have, because the longer your money stays invested, the more compound growth can work in your favor. In this stage of life, your main objective is simple: growth. You typically have decades before retirement, which means short-term market drops matter much less. This allows younger investors to take more risk in exchange for higher potential returns. A common portfolio allocation in your 20s could look like this: around 80 to 90% invested in stocks or stock index funds, and about 10 to 20% in safer assets like bonds or cash. Stocks may fluctuate more in the short term, but historically they have provided stronger long-term growth compared to more conservative investments. At this age, consistency matters more than perfection. Trying to time the market or pick winning stocks is far less important than investing regularly. Small contributions made consistently can grow significantly over time thanks to compounding. Another key focus during your 20s is building the habit of investing. Automation helps. Setting up automatic contributions removes emotion and builds discipline. Market crashes during this period should not be feared. In many cases, they become opportunities to buy investments at lower prices. The biggest mistake young investors make is being too conservative too early. Playing it too safe can limit long-term growth. Your portfolio doesn't need to be perfect. It just needs time to grow. As life progresses, responsibilities increase, income grows, and financial priorities begin to shift. Which brings us to how investing changes in your 30s. In your 30s, investing enters a new stage. This is often the decade where financial life becomes more complex. Careers advance, income usually increases, and many people begin taking on larger responsibilities like mortgages, families, or long-term financial commitments. Because of this, your investment strategy starts to balance two goals: continuing growth while slowly adding stability. You still have a long investment horizon ahead, but protecting progress becomes more important than in your 20s. A typical portfolio allocation during this phase may look like around 70 to 80% in stocks or equity index funds, and 20 to 30% in bonds or more stable investments. Stocks remain the primary growth engine, but diversification begins to play a bigger role. Instead of focusing only on growth, investors start thinking about risk management. This can include investing across different industries, global markets, and asset types. Another key priority in your 30s is consistency and automation. As income grows, increasing your investment contributions can have a massive long-term impact. This is also the stage where tax-advantaged accounts become extremely valuable. For Canadian investors, accounts like a TFSA or RRSP can help investments grow more efficiently by reducing taxes over time. The biggest mistake investors make in their 30s is lifestyle inflation. As income rises, spending often rises just as fast. But increasing investments along with income can dramatically accelerate wealth building. Your goal in this decade is not just investing more, it's building momentum, because the decisions made during your 30s often determine how comfortable your financial future will be. Next, we move into the 40s, where investing becomes a balance between growth and protection. By the time investors reach their 40s, the focus of investing begins to shift again. Retirement is no longer a distant idea. It starts becoming a real timeline. You may still have 20 years or more before retirement, but protecting the wealth you've built becomes increasingly important. This stage is about balance. You still need growth to outpace inflation and continue building wealth, but you also want to reduce the impact of major market swings. A common portfolio allocation in your 40s may look like around 60 to 70% invested in stocks, and 30 to 40% in bonds or more stable assets. This adjustment helps smooth volatility while still allowing long-term growth. At this point, large market losses feel different than they did in your 20s. Recovering from a major downturn takes time, and time is no longer unlimited. Diversification becomes essential. Investors often expand beyond simple stock exposure by adding income-producing assets or broader market funds. Another important concept during this phase is portfolio rebalancing. Over time, some investments grow faster than others, changing your risk level without you noticing. Rebalancing means periodically adjusting your portfolio back to your target allocation. This helps control risk and maintain discipline. Emotion can also become a bigger challenge in this decade. Market drops may feel more stressful because retirement is approaching, but reacting emotionally, selling during downturns, can damage long-term results. The goal in your 40s is steady progress, not maximum risk, not maximum safety, but controlled growth. Next comes the stage where protecting wealth becomes just as important as growing it: investing in your 50s. In your 50s, investing enters a new mindset. The goal is no longer only growth. Now, the focus becomes preservation and stability. Retirement is approaching, which means your portfolio may soon need to provide income rather than just accumulate wealth. You still need growth to keep up with inflation, but avoiding large losses becomes a higher priority. A typical portfolio allocation during this stage may look like around 40 to 50% in stocks and 50 to 60% in bonds, income investments, or safer assets. This shift helps reduce volatility while maintaining some exposure to market growth. At this stage, investors often begin focusing on income-producing investments. These may include dividend-paying stocks, bond funds, or diversified income portfolios. The idea is to create investments that can support future withdrawals while preserving capital. Another important change is risk awareness. A major market drop shortly before retirement can significantly impact long-term financial plans. This is sometimes called sequence of returns risk, when losses occur right before or early in retirement. Because of this, many investors gradually reduce risk instead of making sudden changes. The transition should be slow and intentional, not emotional. One common mistake in this decade is becoming either too aggressive or too conservative. Taking excessive risk can threaten retirement savings, but becoming overly cautious too early can reduce growth needed for a retirement that may last decades. The objective is balance. Protect what you've built while allowing your investments to continue working for you. Now that we've covered each age group, let's simplify everything into one easy rule you can remember. After hearing different strategies for each decade, you might be wondering, is there a simple rule to guide portfolio allocation? There is. Many investors use a basic guideline known as the 100 minus your age rule. The idea is simple. Take the number 100 and subtract your age. The result gives you an approximate percentage of your portfolio that could be invested in stocks. The remaining percentage goes into safer assets like bonds or cash equivalents. For example, if you are 25 years old, 100 minus 25 equals 75. That suggests roughly 75% in stocks and 25% in more stable investments. If you are 40 years old, 100 minus 40 equals 60, so about 60% stocks and 40% safer assets. And if you're 55 years old, you might hold around 45% stocks and 55% conservative investments. This rule isn't perfect. It's a starting point. Some investors adjust the rule to 110 minus age to allow slightly more growth, especially because people live longer today. The key lesson is not the exact numbers. It's understanding that risk should gradually decrease as time horizons become shorter. Your portfolio should evolve slowly over time, not change suddenly based on market headlines. Consistency and adjustment matter more than prediction. Now, before we finish, let's talk about the biggest mistake investors make at every age. No matter their age, most investors make the same mistake. They copy strategies that were never designed for their situation. A young investor follows ultra-safe advice meant for retirees. An older investor chases risky trends designed for long time horizons. And many people never adjust their portfolio at all. They invest once and forget that their strategy should evolve as their life changes. Good investing is not about excitement. It's about alignment. Your investments should match your goals, your timeline, and your tolerance for risk. Another common mistake is reacting emotionally to market movements, buying when markets feel exciting and selling when markets feel scary. But successful investors understand that markets move in cycles. Discipline matters more than prediction. The goal isn't to perfectly time the market. The goal is to stay invested with a strategy appropriate for your stage of life. If you remember one thing from this video, let it be this: invest aggressively when time is on your side. Gradually reduce risk as your need for stability increases, and allow your portfolio to grow with you. Because investing isn't about finding a single perfect strategy. It's about using the right strategy at the right time. If you found this helpful, consider subscribing for more simple investing explanations designed to make finance easier to understand. And tell me in the comments, which age group are you currently investing in? Thanks for watching, and I'll see you in the next video.